Imagine a 200-year-old soap and toothpaste company that is secretly operating like a Silicon Valley tech firm.
Right. It sounds like a complete contradiction.
It really does. You look at the outside and you see this legacy brand, right?
Yeah.
Just the stuff sitting on your grandmother's bathroom counter.
Yeah, exactly.
But today, we are looking under the hood of Colgate-Palmolive's latest earnings call, and buried beneath all the toothpaste sales and the dog food shipments is this massive pivot.
Huge pivot.
Yeah, to artificial intelligence, predictive supply chains, and just aggressive global pricing power.
I mean, we are talking about a consumer packaged goods giant deploying AI agents to optimize global markets in real time. It's wild.
It really is. So welcome to this deep dive. If you are an investor holding consumer staple stocks, or if you're just trying to figure out where the modern economy is actually heading, this is the breakdown you need. We are going to cut through all the corporate jargon of their Q2 2026 earnings call, extract the raw data, and figure out if ticker symbol CL is a strong defensive hold, a fresh buy, or, well, a flashing warning sign for your portfolio.
And I have to say, it is a phenomenal quarter to dissect.
Oh, yeah.
Yeah, largely because it challenges so many assumptions that retail investors have about mature, slow growth companies.
Right. The boring staples.
Exactly. I mean, we're seeing margin expansion in an environment where most companies are getting absolutely crushed by input costs.
Getting completely squeezed.
Yeah. And we are seeing some aggressive strategic bets in emerging markets that, frankly, I didn't think a company of this size had the agility to execute.
Well, before we get into the heavy data and all those strategic bets, I do have to bring up a piece of context from the very top of the call that I found genuinely fascinating.
Oh, the send-off.
Yes. So this was the 40th quarterly earnings call for Colgate's veteran of investor relations, John Poach.
40 quarters.
Yeah, 40. And it was his final one before retirement. Management gave him this massive send-off with the CEO literally quoting Han Solo saying, may the force be with you.
Which is pretty great for an earnings call.
It's fun, right. But putting the sentimentality aside, 40 quarters is an absolute eternity on Wall Street.
It's 10 full years of market cycle.
Exactly. He has guided this company's narrative through a global pandemic, massive supply chain collapses, historical inflation spikes, and now the AI transition.
Yeah. 10 years in that IR seat for a global conglomerate means you have had to explain every possible macroeconomic disaster.
Right.
And you're doing it to analysts who are demanding constant linear growth. It's a grueling job.
Oh, no doubt.
And to your point about the Han Solo quote, it is a fun send-off, but as an investor, sentiment doesn't pay dividends.
Good point.
The actual question we have to answer today is whether the force is actually with Colgate right now, or if they are just riding on the fumes of past pricing power.
Right. So let's start answering that by looking at the headline numbers.
Let's do it.
And I want to jump straight into the composition of their organic sales, because on paper, it looks like a powerhouse quarter.
It really does.
They posted organic sales growth in 4 of their 5 divisions and in 3 of their 4 major product categories.
Which is broad-based strength.
Yeah. Free cash flow is up 18%, which, is the kind of metric that makes dividend investors sleep very soundly at night.
Oh, absolutely.
And they returned a massive $1.4 billion to shareholders.
Wow.
But organic growth is the metric everyone focuses on, right? So I want to debate the quality of this growth.
Okay, let's unpack that.
Because for the last 3 years, CPG companies have been printing 3%, 4%, 5% organic growth purely by jacking up prices.
Right, the inflation playbook.
Exactly. While their actual volume, like the physical number of items sold, was shrinking.
And that has been the dirty little secret of the entire consumer staples sector since inflation took off.
Just hiding behind price hikes.
Yeah, you report record revenue, but you are moving fewer boxes out of the warehouse.
Right.
The consumer was just absorbing the price shock.
Because they had to.
Right. But what we are looking for now in 2026 is a transition. We need to see volume recovery.
And are we seeing that here?
We are. The high-quality organic growth we are seeing in portions of Colgate's report suggests they're finally transitioning away from relying solely on price hikes.
Okay.
When a massive, mature company like this is driving organic growth across almost all its divisions globally and balancing that between pricing and actual physical volume, it means the core machinery is remarkably resilient.
Okay, the core machinery is resilient, but let's talk about the profitability of that machinery.
The margin.
Yes, because the absolute standout number for me, like the biggest win of this entire earnings call, is the gross margin.
It was a huge beat.
They expanded gross margin by 100 basis points year over year, and it's up 90 basis points just sequentially from the first quarter.
Which is staggering.
It is. To put that in perspective, for anyone tracking consumer packaged goods, expanding margins by a full percentage point in a highly volatile inflationary environment is huge.
It's the holy grail right now.
We are talking about tens of millions of dollars dropping directly to the bottom line simply because they are operating more efficiently.
Yeah, because the cost of raw materials, labor, specialized chemicals, and global freight have been totally chaotic.
Right?
So for a CPG company to not only maintain their margin but expand it by 100 basis points means they have achieved an incredible balancing act.
Like so.
Well, they successfully passed remaining input costs onto the consumer, but they also optimized their product mix. They are pushing higher margin items, premium toothpaste, specialized pet foods, and pulling back on lower margin bulk goods.
That makes sense.
That positive product mix is what really drives a 100 basis point expansion. It proves they have absolute pricing power, and more importantly, they haven't destroyed consumer demand in the process of exercising it.
Now, I do want to challenge a specific detail here, because management mentioned during the call that this gross margin figure included a, quote, modest tariff benefit or refund.
I noticed that too.
Right. And when I hear that, my immediate reaction is skepticism. Are they inflating this massive margin win with a one-time government refund?
The fair question.
Because if they are padding the stats with a check from the Customs Department, that 100 basis point expansion isn't sustainable core strength, it's an accounting fluke.
Yeah, that is the exact thread an analyst needs to pull during the Q&A, and thankfully someone did.
Good. What did they say?
The CFO, Stan, stepped in to clarify the composition of that margin growth. He acknowledged the tariff refund, but he broke down the math to show that the overwhelming bulk of that expansion came directly from core business operations.
Okay, so it wasn't just a gimmick.
No, not at all.
Yeah.
It was driven by sustained pricing strategies, the positive product mix we just discussed, and massive internal productivity programs.
Right.
The tariff refunds was a tailwind, certainly, but if you strip it out entirely, you are still looking at a phenomenal market-leading margin expansion. It proves the operational leverage of the business is intact.
Which brings us to a massive paradox in this earnings report.
That's that.
Because they have this incredibly profitable core engine, and their base business earnings per share came in ahead of expectations.
Yeah, a solid EPS beat.
But they achieved this EPS beat while simultaneously delivering a double-digit increase in advertising spend.
Right.
Advertising is now sitting at 14% of total sales. 14%.
It's massive.
That is hovering near a 20-year high for this company. So I look at that and I have to ask, is this actually a sign of strength? Or is it a massive red flag?
How do you mean?
Well, if customer acquisition costs are spiking across the digital landscape, are they just trapped on a treadmill? Like, are they having to spend a massive fortune just to keep sales from sinking?
That's the classic bear thesis for consumer brands right now. The argument is that retail media networks, advertising directly on Amazon, Walmart Connect, Target's platforms, have become so expensive that brands are paying a toll just to stay on the digital shelf.
A toll, exactly.
So if your organic growth is 3%, but your ad spend has to jump 15% just to achieve that, your return on invested capital is degrading rapidly.
Right. You are running faster just to stay in the exact same place.
Exactly my concern. You are essentially paying Walmart for the privilege of selling a product at Walmart. And that eats into the margin you just fought so hard to expand.
Yes.
But if you look at the entirety of the P&L, the profit and loss statement management presents a very different and very compelling narrative.
Okay, what's their spin?
Because their gross margins are so strong right now, they have created immense flexibility in their financials. They have excess cash generation.
Okay.
A short-sighted management team would let that cash flow straight to the bottom line. They would report an unbelievable blowout quarter for EPS, collect their bonuses, and let the stock pop.
Which happens all the time.
Exactly. But instead, they're taking that gross margin win and deliberately suppressing their short-term earnings beat to reinvest in long-term brand health.
Okay, so they are building a moat rather than just buying this week's volume with heavy discounting.
Precisely the opposite of heavy discounting. They aren't printing 50-cent off coupons to artificially spike sales for the quarter.
Which just trains the consumer to only buy on a deal anyway.
Right. They are investing heavily in upper funnel brand equity.
Right.
In a world where media is incredibly fragmented and digital customer acquisition is ruthless, They are using their balance sheet strength to simply outshout smaller, undercapitalized competitors.
Ah, I see.
The 14% ad spend isn't a treadmill, it's an aggressive defensive perimeter. They are cementing their market share so that when the macroeconomic environment fully normalizes, they own the consumer relationship outright.
Okay, that makes sense. It's a flex of financial muscle.
Yeah.
So management is spending a fortune to protect these margins and build this moat, but where is that money actually working?
That's the million-dollar question.
Because when you look at the global map of Colgate's operations, the divergences are just wild.
Oh, absolutely.
Let's explore the bull case first. And to do that, we have to look at emerging markets and their global premiumization strategy.
Yeah, Latin America is a great example.
Yes. Latin America is carrying a massive amount of weight right now. Overall sales in the region were up 5%.
Which is very strong.
But the crucial detail is the balance, right? Pricing was up 2.8%, and physical volume was up 2.6%.
It's perfectly balanced.
Yeah, they are driving true high-quality growth in markets like Brazil, which was up high single digits, and Mexico, which was up mid-single digits.
Latin America is a masterclass in market recovery for them. To appreciate that 2.6% volume growth, you have to look at the historical context.
Right, because it wasn't always going this well.
No. Over the last year, Colgate experienced a significant stumble in the region regarding their flagship Colgate Total brand.
Oh, the reformulation.
Yes. They attempted a reformulation, and the execution was rocky. They alienated a portion of their core consumer base and blood market share to local competitors.
It's the classic danger of the CPG world.
Yes.
You mess with a product someone puts in their mouth every single morning, and if the texture's off by a fraction, they immediately jump ship to a competitor.
Exactly.
It's like the new Coke debacle, but playing out on the oral care aisle.
Yeah, and winning back a consumer who felt betrayed by a reformulation is incredibly expensive and difficult.
I bet.
But what the Q2 data shows is that the recovery plan worked. They have successfully clawed back that premium brand share, particularly in Brazil.
Wow.
The volume is returning because they didn't just slash prices to win people back. They fixed the product messaging, leaned into that 14% ad spend, and re-engaged the consumer on the value of the premium formulation.
It is a great recovery story, but if we want to talk about premiumization, we have to jump across the Atlantic to Europe.
Europe is fascinating right now.
Because the macroeconomic picture in Europe right now is grim. You have severe consumer stress, sticky inflation, and volatile energy costs.
Yeah, it's a tough environment.
By all traditional metrics, a consumer staples company should be struggling to push anything other than discount bulk items, and yet Colgate's European division is posting solid growth.
Because Europe is the ultimate proving ground for their super premium strategy.
The Elmex brand.
Exactly. They are completely ignoring the race to the bottom. Instead of fighting private label grocery store brands on price, they are aggressively pushing the Elmex brand.
And that's not cheap.
Not at all. Elmex is positioned completely differently than standard Colgate. It's marketed almost as a clinical, therapeutic oral care regimen.
Right.
It commands a massive price premium, and it targets a demographic that is largely insulated from macroeconomic shocks.
It's essentially the lipstick index, but applied to toothpaste.
That's a great way to put it.
The idea that even in a recession, consumers will still splurge on small daily luxuries. If a European consumer feels they can't afford a major vacation or a new car this year, they can still justify the €8 therapeutic toothpaste because it feels like an investment in their personal health.
That psychological dynamic is exactly what is driving the growth.
Right.
And the critical takeaway for investors is that Colgate's management is looking at the margins Elmex is generating in a stressed European market, and they realize they are severely under-indexed in the super premium category globally.
Oh, so they want to expand it.
Yeah, they are taking this high-margin, therapeutic-level product strategy and actively exporting it to the rest of the world. It provides a massive runway for margin expansion over the next 5 years if they can replicate the European success in North America or Asia.
Speaking of Asia, we have to look at China.
Yes, China.
Because for Western consumer brands, China has been a graveyard recently.
It really has.
The domestic competition has gotten fierce, and consumer nationalism has hurt foreign brands. But Colgate seems to have cracked the code for a turnaround, specifically with their Darlie brand.
Yeah, the Darlie turnaround is rooted in deep, localized product innovation.
Like what?
Well, they launched a dual-chamber toothpaste that resonated heavily with the Chinese consumer. But it's not just the physical product, it's the distribution model.
The e-commerce shift.
Exactly. China's retail landscape has shifted away from traditional brick-and-mortar hypermarkets toward advanced e-commerce and live streaming commerce at a pace that Western markets haven't even begun to comprehend.
We are talking about live commerce on platforms like Douyin, the Chinese version of TikTok, right?
Yes.
Where influencers are moving millions of dollars of inventory in a single hour.
And Colgate adapted to that reality. Management noted that their e-commerce growth in China is so robust that it is completely offsetting the double-digit declines they're experiencing in physical retail stores.
Wow, so it's fully replacing the lost foot traffic.
Exactly. They are successfully meeting the Chinese consumer exactly where they shop today. Furthermore, they developed a product called Optic White Purple, specifically for the Asian market, built a social-first marketing campaign around it, and it was so successful that they are now reverse exporting that product and that digital playbook back to Western markets.
That is the hallmark of a healthy, decentralized corporate structure.
Absolutely.
They aren't forcing a New York-centric marketing plan down the throats of their Asian divisions. They are letting the local markets innovate and then scaling the winners globally.
It's very smart.
Okay, so emerging markets, Europe and Asia all look solid. But if we are building the ultimate bull case for this stock, we have to spend some serious time on the crown jewel of the entire portfolio.
Hill's.
Yes, we need to talk about Hill's Pet Nutrition.
Hill's is a fascinating case study in building an impregnable economic moat.
So the headline number is that organic growth for Hill's was up 4%. But if you read the transcript closely, that number is actually deceivingly low.
Why is that?
Management pointed out that they made a strategic decision to exit a massive chunk of their private label manufacturing business. They deliberately dumped 200 basis points of low-margin revenue.
Oh, wow.
If you exclude that strategic exit, the core branded Hill's business is growing significantly faster than 4%.
Right, because they are shedding the low-quality revenue to focus entirely on the high-margin therapeutic lines.
And their therapeutic lines are booming. I was reading the breakdown of their new product launch. It's called Prime, and it's a single protein fresh pet food.
Okay.
But what struck me was the language management used to describe the rollout. They don't talk about it like a consumer packaged good. They aren't trying to secure end cap displays at Walmart or heavy promotions at big box pet stores.
How are they rolling it out?
They are rolling it out with the strict, methodical pacing of a pharmaceutical company launching a prescription drug.
Because in the eyes of the consumer, that is exactly what it is. The pet food market is incredibly crowded right now. You have an explosion of direct-to-consumer boutique brands leveraging Instagram and TikTok to sell fresh, human-grade food directly to pet owners.
Right, the trendy stuff in the mail.
Yeah, they rely heavily on emotional marketing and trendy packaging.
But Hill's bypasses that entire digital marketing war by leveraging the veterinary channel.
And that channel is the ultimate competitive moat.
It really is.
Think about the consumer psychology. When you take your dog to the vet, because it has a severe digestive issue or a kidney problem, and the licensed veterinarian hands you a bag of Hill's prescription diet and says, this is the only thing your dog can eat, you do not go home and search Instagram for a trendy, cheaper alternative.
No, you definitely don't.
You buy exactly what the medical professional prescribed, and you keep buying it for the rest of the dog's life.
The lifetime value of that customer is astronomical. The lock-in is absolute. You trust the doctor, and price sensitivity almost entirely disappears because it's a medical necessity for a family member.
That vet recommendation model gives Hill's pricing power that those direct-to-consumer brands could only dream of. The boutique brands cannot simply replicate a 50-year relationship with the global veterinary profession.
Right.
So when Colgate says they are launching Prime slowly and funneling it strictly through veterinary professionals to build science-based credibility, they are playing a brilliant long-term game. They are reinforcing a barrier to entry that protects their premium margins from trendy upstarts.
Okay, so the international oral care engine is humming, and the pet food division is a fortress of medical-grade pricing power. If that were the entire report, the stock would be up 20%.
Yeah, if only.
But we promised the listener the complete, unvarnished story, and it is time to pivot to the bear case. Because there was one massive, glaring issue on this call, and that is the North American market.
The North American stumble is the flashing yellow light of this entire earnings report.
The data here is ugly. North America's shipments were down 3%.
Which hurts.
But the confusion arises when you look at actual consumer consumption, meaning the scan data at the cash registers. The amount of toothpaste consumers actually purchased was completely flat.
Right.
So help us reconcile this. How does a company report a 3% drop in shipments, implying a massive loss of revenue, when the consumer at the store level hasn't changed their buying habits at all?
It comes down to a phenomenon in supply chain dynamics known as the bullwhip effect, driven by aggressive inventory destocking at the retail level.
Let's break down the mechanics of this bullwhip effect. Walk me through exactly what is happening between a company like Target or Walmart and a supplier like Colgate.
Okay. Put yourself in the shoes of a massive retail buyer, the person responsible for managing the inventory of the entire health and beauty aisle for a national chain. Your bonus and your job security are tied to inventory turnover and working capital metrics. In May, you start seeing macroeconomic data flashing red. High gas prices are peaking, credit card delinquencies are ticking up, and consumer foot traffic in your stores is slowing down.
The classic signs of a tapped-out U.S. consumer.
Exactly. So as the retail buyer, you panic. You look at your warehouse and you see millions of dollars of Colgate toothpaste sitting on pallets. You do not want that cash tied up in inventory if the consumer is about to pull back sharply.
Right, you want the cash.
So to protect your metrics, you make a drastic decision. Instead of ordering your usual 10,000 cases from Colgate this month to replenish the shelves, you only order 7,000. You decide to intentionally bleed down the inventory you already hold in your back rooms.
You starve the supplier to protect your own balance sheet.
Exactly. Now, the end consumer is still walking into the store and buying their one tube of toothpaste every month. The cash register data, the consumption, remains flat. But because the retailer artificially slammed the brakes on their wholesale orders, Colgate experiences a sudden, violent 3% drop in factory shipments. That is inventory destocking. It's an artificial demand shock created by the retailer, not the consumer.
I understand the mechanics, but I want to push back on the narrative that this is just a harmless supply chain quirk.
Go for it.
Management tried to brush this off, noting that order patterns normalized a bit in June and July as gas prices eased. But if I look at the broader macro environment, inflation has depleted pandemic savings, credit card debt is at record highs, and interest rates are squeezing the middle class.
It's grim.
Are we absolutely sure this destocking was just a one-month panic attack by a Target inventory manager? Because to me, it looks like retailers are anticipating a systemic, long-term demand destruction in North America.
It is a completely valid challenge, and it's the exact reason the stock didn't absolutely skyrocket on the margin news.
Right.
Management was remarkably candid during the Q&A. They didn't try to completely sugarcoat it. They admitted they were deeply disappointed with their Q2 U.S. performance, and crucially, they acknowledged that they actually lost market share to competitors during this chaos.
Wow, okay.
When a brand as dominant as Colgate loses shelf share in its home territory, you cannot dismiss it as just a supply chain blip. It indicates that competitors were either more agile with their promotions or that the consumer did in fact trade down to cheaper alternatives when they were standing in the aisle.
So the U.S. market is bleeding and they are losing share. That transitions us perfectly into management guidance. What is their action plan for the rest of 2026? Because they can't just sit back and hope the U.S. consumer magically feels richer by October.
The guidance section of the call was a masterclass in managing Wall Street's expectations while quietly executing a massive operational shift.
Let's start with the loudest signal they sent to the market, the margin guidance upgrade.
Yeah, that was bold.
Despite the chaos in the U.S., management confidently raised their full-year gross margin guidance from down to roughly flat. For a company dealing with market share loss in its biggest territory, raising margin guidance takes a lot of nerve.
It takes nerve, but it also requires a deep understanding of their own cost phasing. The CFO broke down the cadence for the rest of the year. The third quarter margins are essentially locked in.
Because of forward contracts.
Right. They have forward contracts on the raw materials, and their pricing structures are set. The wild card is the fourth quarter. They are projecting that the cost of raw materials, specifically the specialized chemicals and packaging materials they rely on, will peak in the back half of the year.
Plus all the global freight issues.
Add in the volatility of global freight and geopolitical instability, and they know Q4 is going to be incredibly expensive.
So the fact that they are guiding for a flat year, knowing that a massive wave of costs is going to hit them in Q4, implies that their execution in Q2 and Q3 was so aggressively profitable that it provides a massive cushion against the end-of-year headwinds.
It is a massive flex of operational confidence. But the strategy to maintain that revenue growth is shifting entirely. Management explicitly stated that for the back half of 2026, growth has to be driven by volume, not pricing.
This is the inflection point for the entire CPG industry. The free ride is over.
Yeah.
For 3 years, you could blame inflation, hike your prices by 9%, and Wall Street would applaud your revenue growth even if your factories were producing fewer goods. But the consumer has hit a wall. You cannot squeeze another dime out of them.
Exactly.
To grow top-line revenue now, Colgate actually has to manufacture and sell more physical items.
Furthermore, they pointed out that the foreign exchange tailwinds, the currency fluctuations that artificially boosted their international revenue numbers in the first half of the year, are fading. They have to earn every single dollar of growth organically by moving units.
Which makes fixing the North American stumble absolutely critical. And management laid out a very specific 3-part playbook to engineer this U.S. turnaround.
What's step 1?
First, they're accelerating the rollout of their 2026 and 2027 product innovations. They highlighted the Optic White Pro series with active shine technology and completely new formulations of the Fabuloso cleaning brand.
Again, relying on premiumization. If you need to drive volume, introducing a novel, highly marketed premium product is the fastest way to get the consumer's attention and justify a premium price point simultaneously.
The second part of the playbook is where it gets highly technical. They talked about executing surgical price gap adjustments against their competitors.
This is fascinating.
Walk us through the mechanics of a surgical adjustment. How does a company like Colgate actually execute this without triggering a race to the bottom?
When a CPG company loses market share, the panic response is broad-based discounting. You slash the price of every tube of toothpaste by 20% nationwide to try and flood the market.
Which ruins your margin.
But that destroys your brand equity and obliterates your margins. Surgical pricing requires immense data infrastructure. They are analyzing real-time scan data at the regional and store level. They identified that in a specific chain of grocery stores in the Midwest, their flagship product is priced 40 cents higher than a direct competitor, and that specific 40-cent gap is causing consumers to switch brands.
So instead of a national discount, they deploy a highly targeted, localized trade promotion, like a digital coupon or a store-specific rebate, to close that exact 40-cent gap only where it matters.
It is incredibly disciplined. They defend their market share block by block, store by store, without degrading the baseline price of the product nationally.
And the third leg of this turnaround strategy loops back to our earlier discussion. They are deploying that massive 14% advertising budget directly into the U.S. market to blast these innovations and promotions out to the consumer.
They are going to spend their way out of this market share dip.
But this aggressive playbook leads me to a massive contradiction in their guidance. If they have this airtight strategy and international markets are booming, why is their top-line revenue guidance so remarkably weak?
It does seem odd.
Their year-to-date organic sales are running at 2.6%, but the lower end of their full-year guidance implies that revenue growth will essentially flatline in the back half of the year.
I look at that revenue guide, and I see a masterclass in corporate sandbagging.
You think they're intentionally lowballing Wall Street?
Absolutely. Look at the macro landscape from the perspective of a CEO. You have retailer boycotts erupting in various international markets over geopolitical issues. You have gas prices causing massive volatility in U.S. consumer confidence month to month. You have an election cycle creating uncertainty.
Right.
If you were sitting in the C-suite, the absolute last thing you want to do right now is promise the market aggressive growth.
You set a bar that is so incredibly low you can trip over it and still look like a genius.
It's the ultimate asymmetric risk profile for management. If the U.S. consumer rebounds and the destocking phase ends, they blow past the flat guidance and get rewarded with a massive stock bump.
And if it doesn't?
If the macroeconomic environment deteriorates further, they shrug their shoulders, point to their conservative guidance and say, "We warned you." They are protecting themselves.
Okay, we have ripped apart the headline numbers, we've analyzed the global premiumization strategy, dissected the veterinary moat, and exposed the mechanics of the U.S. retail bullwhip effect.
We covered a lot.
It is time to deliver on the core promise of this deep dive. Let's synthesize all of this data into a bottom line. What is the actionable takeaway for the retail investor listening to this right now? Where do we stand on CL?
Based on the underlying strength of the margin expansion and the resilience of the international divisions, the stance here has to be cautiously bullish.
Cautiously bullish is exactly where I land too. If we summarize the core thesis, the international engine is proving to be incredibly robust. Latin America has successfully navigated a brand crisis and is driving balanced volume and price growth.
Europe is defying a recessionary environment by leaning heavily into the Elmex super premium strategy, proving the therapeutic oral care market is somewhat inelastic.
China is demonstrating agility by pivoting away from dying brick-and-mortar stores and dominating the e-commerce and social-first channels.
And underpinning all of this is Hill's Pet Nutrition, which operates less like a consumer brand and more like a high-margin pharmaceutical business with absolute pricing power through the veterinary channel.
That global machinery is incredibly strong. But the caution in our cautiously bullish stance is entirely anchored in North America. The U.S. consumer destocking issue is not something you can just wave away.
No, you really can't.
If you are an investor, you have to monitor the macroeconomic data closely. We don't know for certain if that retailer panic in May was just a localized reaction to a spike in gas prices, or if it is the leading edge of a severe systemic consumer pullback. If the U.S. consumer breaks, even surgical pricing won't be enough to hold the line on volume.
Absolutely.
So let's make this highly actionable based on time horizons. If you are a listener who manages a short-term, momentum-driven trading portfolio, how should you play this?
If your time horizon is measured in weeks or months, the U.S. retail volatility makes this a very tricky trade. You are likely going to see the stock price chop around violently as conflicting macroeconomic headlines hit the tape.
Right.
One week you'll see strong retail sales data, and the next week you'll hear about another massive chain aggressively destocking their warehouses. The uncertainty around the North American turnaround plan might create too much turbulence for a clean momentum play.
But what if you are a long-term buy and hold investor, the kind of person holding this stock in a retirement account for the dividend yield and the compounding growth?
If that is your profile, this earnings call should let you sleep incredibly well. The ability to generate a 100 basis point margin expansion in one of the most volatile inflationary environments in modern history is a monumental operational achievement.
It really is.
The 18% growth in free cash flow is the ultimate safety net. It means their dividend payout is secure, and they have an immense war chest of capital to continue repurchasing shares and supporting the stock price.
And for the listener who doesn't currently own the stock, but is sitting on cash and looking for an entry point,
patience is your best asset here. I would wait for the Q3 earnings report. You want empirical proof that the U.S. inventory destocking was a one-off event.
You want to see the turnaround actually working.
Exactly. You want to see data proving that their surgical pricing algorithms and their massive 14% ad spend are actually successfully clawing back the market share they bled in Q2. Let management prove the turnaround playbook works before you commit new capital.
Before we wrap up the financial analysis, do you have one final takeaway on the numbers?
I keep coming back to that 14% advertising budget. The fact that management is choosing to fund near record levels of marketing out of their own margin growth, rather than letting it flow to the bottom line to artificially pump the stock, tells you everything you need to know about their corporate culture. They are playing chess, not checkers. They're willing to take a little heat on short-term earnings to build an impenetrable wall of brand equity. When global consumer confidence finally normalizes, the companies that maintain their advertising presence during the downturn are the ones who will capture the disproportionate share of the recovery.
That is a brilliant way to frame it. But I cannot let you leave without discussing the absolute wildest moment of this entire earnings call.
Oh, the AI stuff.
Yes. Because at the very tail end of the Q&A session, an analyst asked a seemingly mundane question about internal efficiencies, and the CEO dropped a piece of information that completely reframes how we should look at this entire industry.
It was a shocking moment. It felt like a transcript error. You expect this kind of rhetoric on a Microsoft or NVIDIA call, not from a company that sells dish soap and dog food.
The CEO casually revealed that 80% of their vice president level staff worldwide have now been formally trained in advanced artificial intelligence.
And we need to clarify what they mean by that. They aren't talking about executives playing around with ChatGPT to draft emails.
No.
Management detailed the rollout of internal proprietary AI hubs. They are training their global leadership on how to integrate large language models directly into their daily operational workflows.
They explicitly mentioned the deployment of internal tools called Promo AI and something they referred to as agentic commerce. We touched on the surgical pricing earlier, but this is the engine behind it.
It's unbelievable.
They are using autonomous AI agents to manage localized pricing strategies, to instantly optimize global supply chain routing when a disruption occurs, and to rapidly generate and translate marketing content in one region and instantly deploy it to another based on real-time social media trends.
This is the hidden revolution in the legacy corporate world.
Think about the implications for the stock market. We spend all our time obsessing over which tech company is going to build the best foundational AI model. We argue about chip manufacturers and server farms.
Right, the obvious plays.
But what if the real, tangible financial value of AI over the next decade isn't captured by the companies building the tech, but by the boring 200-year-old legacy companies that successfully deploy it to strip out massive inefficiencies?
That is the multi-billion-dollar question. If a massive conglomerate like Colgate can use agentic commerce to squeeze an extra 50 basis points of efficiency out of their supply chain logistics, or use Promo AI to lower their customer acquisition cost by 10%, that translates to hundreds of millions of dollars in new structural free cash flow.
And more importantly, it creates an insurmountable technological gap between the legacy companies that adapt and the ones that don't. Imagine being a mid-tier regional toothpaste brand trying to compete with Colgate in 2028.
You'd have no chance.
You are making pricing decisions based on spreadsheets and month-old sales data, while Colgate has an autonomous AI agent adjusting trade promotions store by store in real time based on weather patterns and localized search traffic. It's not even a fair fight.
It completely shatters the traditional framework for analyzing consumer staple stocks. The evaluation is no longer just about who has the best brand of soap or who can secure the best shelf space at Walmart.
Right.
It's about which management team has the vision and the technical infrastructure to fundamentally transform their operations into a data-driven technology platform that happens to sell physical goods.
It is a phenomenal paradigm shift. The financial landscape is complicated right now, but underneath the noise of inflation and destocking, the fundamental mechanics of how these companies operate is being rewritten in real time. Thank you for joining us for this deep dive into the machinery of global consumer staples.
Thanks for listening.
Keep interrogating the data, keep looking past the headline numbers, and always keep your portfolio sharp. We will see you on the next deep dive.